Hi guys, Tim Melvin here, and in honor of opening day up in Baltimore, the home opener today is the Orioles against the Milwaukee Brewers. I'm wearing my Orioles shirt. You can't really see it, but there's an O on the back. There's a little Maryland shield in here. I bought this shirt at Camden Yards. Nobody ever believes me because the Orioles logos are really hard to find amid all the other stuff going on in the print. However, this is my Orioles tropical shirt, and I wear it with pride on opening day even though we will probably lose our fourth straight ball game. Not a great team right now. There's only a few guys on it that really belong in the majors. Hopefully, all this looks very, very different by the end of the year as some of those folks down in the minor leagues come up to the major league team and we become an actual real baseball team. Until that happens, I've got the Fort Myers Mighty Muscles right down the street. It's the Twins High A. Best seat in the house, $10. Wednesdays are dollar hot dog night, so you know where to find me most Wednesdays for the rest of baseball season. Listen, guys, I was reading some research this week by the folks at Verdad Advisors. That, of course, is Dan Rasmussen's shop. They're doing great work, guys. And if you're interested in empirical looks at the markets, at asset allocation models, at commodities, pure numbers, no, ridiculous opinions, just the numbers. Okay. They are doing incredible work. They don't take outside money. I would tell you to give them some of your money if you met their minimums. They're managing mostly private money, but these guys are doing phenomenal work. You should be reading them along with Alpha Architect, Meb Faber, and Toby Carlisle at the advisor, at his advisory service, the name of which I'm really struggling with at the minute. You should be reading all of those guys. Google them. They're doing incredible research, mostly on the quantitative side. So yes, please read those guys. Anyway, I read some of their research today from Verdad, and it showed that owning stocks when the Fed is hiking interest rates, lousy idea. Not original, right? Marty Zweig came up with this stuff back in the 70s and 80s, but they really crunched the numbers down and they show unequivocally that it's just not a great idea to own stocks when the Fed is actively raising interest rates. In fact, 59% of the months that they studied, going back, quite some time into the 1950s and all the way forward, 59% of the months that the Fed was hiking, the stock market was down. So, odds are really stocked against you most of the time. Nothing good's going to happen when the Fed is raising rates. You need to look for other asset classes and other places to go with the money. Commodities tend to do real well under that environment. And by the way, so do bank stocks, which is good news for us. Looking at this, really not a lot of great signs for the broader market. We're back under the 200-day moving average. Usually not a great sign for stocks. Not a big tech guy, but Andy Lowe and some other guys have proven that some of these moving averages are significant. The 200-day definitely seems to be significant. And again, that shows up in some of the trend following work done by guys like Wes Gray and his team at Alpha Architects and Meg Faber at Cambria Funds. So we're looking at that and say that's not great. Then we've got the yield curve. Okay. The yield curve is not inverted today, but it's only about 20 basis points off. It has inverted on several occasions over the last couple of weeks, which tell us that the markets are not just worried about inflation, which is still very much present, still running at very high levels. They're also worried about whether or not inflation, along with the rate hikes that the Fed is going to do and the balance sheet shrinking that's supposed to begin next month, can actually tip us into a recession. I think the answer to that is yes, guys. I just don't think it's today. We saw an unemployment claims number last Thursday that was the best since 1968. The last time we saw numbers that low, Lyndon Johnson was the president, and Richard Nixon had just won the 1968 election to become the president-elect, with all the fascinating and wonderful news opportunities that provided over the next 6 years or so. Mickey Lolich and the Detroit Tigers had just taken the World Series from Bob Gibson and the St. Louis Cardinals 4-3. And of course, Earl Morrall and the Colts were marching towards the NFC Championship game, where they would resoundingly whip the Cleveland Browns, and then go play the New York Jets in Super Bowl III, which was not a happy time in our house. Now, guys, I want to remind you, we went out to dinner several times this weekend, and it's just, you think about it. We took a lift on Friday night because we wanted to have a couple cocktails out, and so, yeah, people have jobs, but we do have inflation, and inflation is really high in fuel and in food and other necessary items. The lower end of the workforce is getting their butt kicked right now. It's taking all they can put together just to get enough gas to get to work and to keep food on the table and to keep rents paid, because rents are also spiraling out of control in some parts of the country. Certainly true down here. Rents have now reached a really, really ridiculous level. Look, if you're in a retail store, be a little less quick to bark at the clerk. They're probably really having a hard time right now dealing with all of this economically. Wages are going up, but nowhere near as fast as prices. If you're going out to a restaurant, you're taking an Uber, a Lyft, or some other ride share, tip a little bit extra right now. Won't do that much damage to your budget, but it sure might help someone else's who's working and busting their butt to stay off of the public dole and to support their family or to build their future. So be a little kinder to those on the lower end of the workforce right now. Anyway, the war is still chugging along in Ukraine. No changes. Zelensky is begging for everything short of nuclear bombs to employ against the Russians. And the United States is quite correctly, I think, dragging our feet about making too much of a commitment as far as, no-fly zones, giving them planes, or anything else that the Russians might decide is an act of war. The last thing we want is World War III in Eastern Europe right now. I know the Russian army doesn't look all that great fighting the Ukrainian army, but I wonder how much better they might look if they were fighting the American army, their enemies since the end of World War II. Could be a whole different picture. Even if we went in and we romped to an easy 1 or 2 year victory, it would still be ugly, nasty, brutal fighting, do great damage to the global economy. And if you think inflation is bad now, oh my goodness, if we had a full-on war, that would look truly awful. So not sure how this resolves. Let's just hope it resolves without spreading too much further. Enough politics, guys. Let's just move right along. This is going to be mildly political. Sorry, we have to. Energy prices are one of the biggest problems out there. And one of the dumbest moves I've seen in just a very long time is this administration releasing 1 million barrels a day from the Strategic Energy Reserve. Yup, that's going to have a short-term impact. It's going to increase supplies a little bit. Other nations around the world are releasing an additional 60 million barrels. So all of this is going to knock prices down a little bit for a short period of time. Eventually, the releases will stop. Here's the thing. We're going to draw our strategic reserves down to the lowest level in decades. They've got to be rebuilt at some point. So we are going to have long-term volatility as the money has to be put back to work. We have to buy it back. If we get an oil spike, we're going to have to buy it back at higher prices. So the answer is not releasing oil from the strategic reserve. The answer is an energy policy that makes more sense than the one we have today. I'm not saying do not continue to invest in renewable technology, because renewables are the eventual future, but it's not happening overnight. We still need to invest in and incentivize folks to get out there and drill for oil and gas, to start building the liquid natural gas shipping vessels that we need, and remake and reshape the energy market and the energy policy in a way that makes sense for our economy and for the global demand for oil and gas. We'll see if it happens. We're long all the infrastructure stuff. We're still buying TYG. If you don't own it, we're telling you, you might want to consider buying it on a pullback here. 18% discount to net asset value. Yield's still a little bit over 8%. Constantly looking for opportunities in that energy space at the type of price that we like to pay. We see them, we'll bring them to you guys. If they're really great ideas, well, we're going to take those just to paid subscribers. So you might want to go to MarketFi, look for my name, and sign up for at least one of my very good services that have provided fantastic returns for subscribers over the last 7 or 8 years. Anyway, the really good news for us as primarily bank stock investors right now is that the spread between mortgage rates and deposit costs, that is widening. Okay, the deposit costs are not rising as quick as other interest rates are. They're rising a little bit. Mortgage rates, on the other hand, are trying to spike. We actually saw some quotes over 5% during the course of the last week. It's settled down a little bit from there, but those net interest margins are starting to widen out. It's going to be fantastic news for bank stock profits in the back half of the year. We're going to continue buying bank stocks. We're not selling anything that we own unless something changes in their capital levels, their loan portfolios, or we get a takeover offer. We get a takeover offer. Well, we'll probably go ahead and sell the stock at that price. One other thing that you might want to take a look at here. There's an interesting activist situation shaping up. After the deal with Lockheed Martin fell through, shares of Aerojet Rocketdyne, they make rocket engines, and that's AJDR, I believe. I'll check that, but AJRD, Aerojet Rocketdyne. They fell back to about $36. They've risen again a little bit because one of the largest shareholders with a 5.2% position, and certainly probably one of the longest shareholders because he's had the stock for 15 years now, Warren Lichtenstein of Steel Partners, who's had a very successful run as a hedge fund manager, as an activist, and now running this, I can't call it anything but a merchant bank. They own a really cool collection of companies and this stake in Aerojet Rocketdyne. He's trying to take over the company, not by a buyout, but by replacing the board. He's nominated 7 directors to the board. He's going to try to take it over by taking over the board. He's got his own plans for what he thinks the company ought to do. He's going to send out a PowerPoint sometime in the next few weeks. Company, of course, is opposed to his nominees being elected. Stock's worth a lot more than it's traded for, guys. The very successful hypersonics test that we did about a month ago used Aerojet's engines. They just got huge orders from United Launch Alliance. The remaking of the defense industry is going to focus on, guess what? Space defense, lots of rocket engines, and hypersonic missiles are going to be the missile and tool of the future, particularly for the Navy. So Aerojet's got a big role to play in all that. The stock's probably dramatically undervalued here. On a pullback, it's probably going to be profitable to go ahead and buy the stock or sell some out of the money put options to back into a position in the stock. Okay, now I've got a great high yield bank for you this week, guys. I'm going to share with you. This is one of my favorites. It's TFSL. It's TFS Financial. They're the holding company for Third Federal Savings and Loan of Cleveland, Ohio. It's a mutual thrift, very unusual that the ownership is 80% by the mutual holding company. We'll get to why that matters here in a second. About 23% of the assets at Third Federal are in securities. I love that because as the securities mature or they throw off cash, that can be reinvested as rates are rising. Their loan portfolio is 88% single-family homes. They have a ridiculous non-performing assets rate of 0.3%. So the stability and rising asset and collateral values in the housing market is fantastic news for this bank. People are paying their mortgages. They're paying their bills. The bank is doing extremely well. It's a 10.4 equity to assets ratio. So they have adequate capital on hand. There's no rush for them to go out and do a second step conversion. They don't need the capital at this point in time. Maybe they will someday. Maybe they won't. They've got 21 branches in Ohio. They've got 16 down in Florida, and they've got 7 loan production offices in the southern end of the state of Ohio. The mutual holding company, as I said, owns about 80% of this bank. That means, guys, book value is dramatically understated. I'm going to separate that out and break it out exactly how for subscribers in this month's Community Bank Stock Investor. So again, go to MarketFi, sign up for that. You'll get to see the exact analysis. The PE ratio is dramatically overstated because these shares are basically treasury stock, guys. They've never been sold. They're just kind of sitting there, so they don't represent any significant percentage of the asset base. More importantly, they routinely waive dividends. So it looks at first glance like this bank's earning 63 cents and paying out, or 70 cents and paying out $1.13. Not the case at all. Most of that dividend is only going to 20% of the shareholders. So everything's either under or overstated in our favor in shares of TFS Financial. Here's the good part. The yield is 7.25%, guys. They're also pretty good about buying back stock. They've got 5.7 million shares left on the current buyback program. When that's all done, I'm sure they're going to pass another one. That's kind of been their track record. They have grown this dividend over the last 5 years by 23% a year. Now, is that going to slow down? Probably, but it's still going to grow. Management is committed to paying that dividend and to growing that dividend. The current yield is 7.27%. Got news for you guys. That's not that far off the long-term annual return of the stock market itself. All you got to add is a couple percentage points, and you're going to beat the pants off an index fund. Pretty sure you're going to get a couple percentages of growth each and every year. Even if it just grows at GDP, you'll have what is approaching a double-digit return from an extremely low-risk mutual thrift where 80% of the shares are still in the hands of the mutual holding company, only 20% outstanding. They're buying some of that back. It's extremely well run. They're very good at underwriting mortgage loans. Just really low risk opportunity, I think, to earn 7.27% with a high degree of confidence that this dividend is going to grow faster than the rate of inflation over time. So anyway, there you go. You've got an activist opportunity. You've got a suggestion once again this week to stay away from the index funds and the big name growth stocks. Here now is one of the best bank stock income opportunities that I have blindly stumbled across so far in 2022. All joking aside, guys, go to MarketFi. I'm going to pop a link into the YouTube description this week, so you can sign up at least for Community Bank Stock Investor and get a lot more of these high income bank stock ideas, because I think that's going to be one of the very best places to invest your money for the next 5 to 10 years, because I don't expect much out of the broad market. Last time we had a lost decade, high yield, low PE bank stocks crushed the 0% return of the indexes. So anyway, that's what I've got for you this week, guys. We ran a little bit long. I'd say I'm sorry, but the truth is I'm not. Hopefully you stayed with us all the way to the end to get this great bank stock idea. I'm Tim Melvin. I'll be back Friday if something interesting happens. If nothing interesting happens, look for another video from me early next week as always. So anyway, thanks for watching, guys. We'll talk again soon.